Hey, attendees, you're in the right place. This is the Get Cash Working webinar. I'm just going to give you a few seconds to commence. We got a big, extremely competent team here today to help you through the topic. It's going to be a good one. Stand by. All right, you know what? Let's just get into it. For those of you that know DMI, we've been in business for 35 years, and our focus has always been on supporting agents with premium operations and marketing service, and then also educational platforms like these. So you'll see all the archived webinars we've done in the past on DMIU. So don't forget about that resource, DMI University. There's also a corresponding collateral there to learn about the topics that could help to shift and move and drive your business. But today in this webinar, we're going to show you how to get cash working for your clients. And today's investors, they're holding record levels of cash. Money markets have attracted inflows with total assets reaching all-time highs of over $6 trillion, more than double since 2020. It's crazy. You're aware that cash comes at a cost, but your clients may not understand the impact on their holdings, right? So that's why we have Timothy Gilfillan. Am I saying that right, Tim? Gilfillan?
Yeah, Gilfillan. Yeah, I mean, I'll respond to whatever. So I'm totally fine with that. I'm flexible when it comes out here.
I'll say Tim Gilfillan. Gilfillan. Okay, there we go. Yeah, from Lincoln perfect. Financial Group. We've just met, but we already love Tim, and then and also Josh Rajan. Appreciate you guys being here. Just a little background on Tim. He joined the Annuity team at Lincoln in 2016. He holds a Series 6, 63, 26, and state licenses. He also possesses his certified annuity specialist designation. Then we also have in the top left Hollywood Square corner there, our very own Eric Baldwin, one of our annuity VPs, bringing decades of annuity experience to this table. So I would just urge everybody to, if you want to engage in conversation, click on the Q&A button, ask your questions. Maureen Walker, don't want to forget Maureen Walker. She is our co-host. She's going to help to manage all that Q&A. She may pop in here and there and ask some questions from the audience to our hosts. And I'd say that's about it, but I think we're ready to move forward. And Eric, I just was wondering if you had any thoughts from your end on this topic or about Lincoln or anything else.
Absolutely, Glenn. Thank you so very much. Listen, we at DMI really appreciate this investment of your time, and we clearly aim to make it worthwhile investment return on your time. Before I turn over to Tim at Lincoln, a phenomenal partner, I just wanted to put in perspective a term that Glenn just used about the amount of cash on the sidelines. That was a 6 with a trillion. Is that correct, Glenn? Like yeah. Trillion with a T?
Yeah.
Just right. Just so we're all on the same page, let's talk about that for just a really quick second. And in terms of seconds, I think we can all embrace 1 million. Well, 1 million seconds is about 11 and a half days. 1 billion seconds is about 32 years. But please take note of this when you understand the size of the prize. 1 trillion seconds, I'm rounding just a little bit here, is 32,000 years. 32,000. People need to appropriately, prudently, suitably redeploy and repurpose. And that's what Tim is here to help us understand and to do. Afterwards, your friends and partners at DMI are going to earn our keep by showing you specific, proven best practices to find and fill those needs, because they are aplenty. I think you would agree that as you profile your prospects and your existing clients alike, you'll find that they are typically somewhat overweight cash, right? So let's make this a real commitment to end the year strong, Q3, Q4, start the new year strong, and help these folks redeploy and repurpose when they need to. Tim, the floor is all yours.
Thanks, Eric.
Well, thank you so much, Eric. And certainly, I want to kick it off by saying we really appreciate the partnership here with DMI and, being a part of here today. And when I hear everybody talking, whether about Glenn or Eric, when you talk about the money that is sitting on the sidelines, it makes me really think of something when it comes down to something, my parents taught me very early on, many years ago, as many of us on this call feel the same way, that actions speak louder than words, right? Like people can say a lot of things, but their actions speak the loudest. But when it comes down to it, people's action with their money speak loudest of all. And they're showing us through their actions that they're scared, right? They're putting money in money markets. They're putting them in like CDs. They're trying to find safe money locations that allow them not to have to feel the pain of a loss. And that's why we're seeing so much money stocked away. And when we look at the latest Fed statistics, at the beginning of the year, we were looking at $6 trillion on the sidelines. At the end of the first quarter of this year, we were up to $6.3 trillion. And at the end of the second quarter of this year, the latest statistics show it just a hair over $6.4 trillion sitting on the sidelines. So when we think about the money that is sitting in money markets out there, it puts us in a tough spot. And at Lincoln, we call that the cash conundrum. So when you think about the conundrum, what to do, how to get that money, it's important to not only look at the money as an opportunity to help, but how can we address the emotional concerns of why people are taking this, asset and keeping it in such a safe location? Because as many of us know on this call, sitting in cash is really not helping anybody. When we think about what inflation has done, over the last 4-5 years, that money sitting in cash is really losing its value at an unbelievable clip. And that's caused a lot of hardships inside of American households. So how can you help? Well, helping is about understanding the bigger picture. So let's go ahead and address that, right? So when you think about it, it's the cost of lost opportunities. So when you're sitting in with cash, though it emotionally creates a connection of safety, there's a hidden cost that in these dialogues we really need to have. And that's the cost of opportunity to watch that money grow. And there are certainly opportunities out there. When having these conversations, it's also critical, and we'll address some of these here today, the ways to help them invest with confidence to alleviate some of that fear or that emotional connection that they're currently using, right now. And then lastly, we're going to highlight not only the conundrum that I kind of talked about and really identify and narrow that down, but we're going to talk about a couple of case studies and strategies that we're seeing being used every day in record numbers, helping America and helping Americans get back involved in a way that gives them the confidence that they know their retirement is secure in the future. So as we look at that, let's start with this first slide. And I'm going to zoom in a little bit here and make it a little bit easier to see on the screen. Historically, people move to cash in the wrong times. And, some people might scratch their heads and say, well, how can it always be a wrong time? Well, by the time they move to cash, historically, when you're looking at this chart is pretty powerful if you look at what it is on the surface. The bluish background, greenish background, that is showing all-time money market holding peaks. And as you can see, we've seen them in 03, 09, 20, 2023. And then certainly as we're continuing to go through 24, we're seeing yet additional peaks to the mountain. But the fact is, they usually move to cash after a loss has already occurred. And then they tend to stay in that position too long. Because again, they're acting on emotion, not on actual opportunity. So in the middle of the screen here is July 2009. We hit a peak back right outside the mortgage crisis of $3.8 trillion. And we already heard Eric say It is thousands of years when you think about that in the time of seconds. So it is a huge feat. At that time, that was the largest cap that we've ever seen sitting inside of money market accounts. But if you notice here on the screen, by the time the overlaid line is the S&P 500's performance, and you'll notice by the time the market crashed, that's when the flight to safety really accelerated. So after they lost the money, they fly to safety because they fear they don't want to lose more. And then as you see the market start to recover right after March of 2009, they're staying in that high peak of money market, failing to get that money back involved and grow with the overall, market turnaround. And the old adage is markets come up, they go down, but it's about being in the right position to capture the rebound, right? And that's what the vast majority of Americans missed back in 2009 as they sat on the sidelines afraid. And by the time they did get back involved, it was almost mid-2011, almost 18 months later than the actual, bottom of the market. So they missed 18 months of capturing that rebound, record swing back in growth. Now, if we go ahead and we look at the chart back in 2022, we saw a quick sell-off again at the tail end of 22. A flight to safety endured through 2023. But again, anybody not taking the opportunity to even look at the S&P 500 missed that incredible rebound. And then we look at today, if we look at the last, what the market did last year on the S&P up over 23%. If we look YOY from 12 months ago through today, markets are up over 22%. They missed, we constantly are setting new high watermarks in money market holdings, but failing to capture getting that cash moving. Couple that with inflation, it's a recipe for disaster of buying power loss. So when we think about it, the emotional opportunity to move the cash is how do we have more confident conversations in order to get the client, more satisfied with that conversation. So let's look at what it actually does in terms of dollars. So stocks historically roar back after cash holdings and money markets have peaked. So when we look at 2003, 2009, 2020, very quickly, I'll show you this slide. If you were go ahead and put your money inside of a money market, $100,000 at those respective dates, at those peaks, and it grew, when you look at the 3 years afterwards, we can see that same 2009 timeframe. If you sat in a money market account, it only grew about 10 basis points or 0.1%. But if you would have utilized an index like the S&P 500, it would have grew almost 20% over that same 3-year period. So the proof is in the pudding here. Getting your clients to go ahead and get involved with index-like options and other market-type investments gets that cash moving, and they fare way better. And that's ultimately why we're all here having this conversation here today. So, better yet, if you look at it from a client point of view, even missing a few days just by trying to time the market can make a drastic impact in the overall loss of an opportunity. So if you put $10,000 in January 1st, 2004 and pulled it out almost 20 years later, if you stayed invested the whole time, that 10 grand grew to about 42,000. If you missed the best 10 days over 20 years, just 10 days over 20 years, those earnings are cut in half. And then if you look at the fact that, you take that out exponentially, if you miss 20 days or the 30 best days over 20 years, you can see that categorically, absolutely either loss or growth that the client leaves on the table just by not staying invested, with simple strategies that allow that money to grow along the way. So when you think about it from that, how often does cash underperform the S&P 500? Almost unilaterally. Over a 1-year basis, all the way through a 25-year basis, long-term cash always underperforms the market. And this is from 1940 through 23, guys. So this is not a cherry pick segment. This is, a great window of looking back. How often does cash underperform the S&P in a 1-year segment? 71% of the time, so 7 out of 10 years. So the fact is, sitting on the sidelines, has never really worked out, but it does make people emotionally feel better. So again, trying to help build that confidence and address the underlying emotion of those investments is critical in having successful conversations. So, as we go ahead and we take that to the next level, when you think about it, when's a good time to get involved, right? We always hear the adage, it's not about timing the market, it's about time in the market. The fact of the matter is, this cool little slide shows you that no matter what noise, politically, war, when you come into, downgrades or flash crashes, the fact of the matter is the cumulative returns of staying invested far outperform the emotional decision to sit on the sideline. And it doesn't matter when you get in, when we look at history, the fact is staying involved means more than trying to time and really get involved. But let's go ahead and see, and I jokingly, before this call, I was joking with Glenn on, I call this the Nostradamus of slides. The economy is not the market, guys, right? Like we know, when people are out there spending money, it typically feels different than we see in the stock market. Look at today. Stock market keeps setting records, but everybody at the supermarket feels like the prices keep going up, not getting any relief. It's harder to feed our families. But I call this slide the Nostradamus of slides, right? So think about it. If we remember who Nostradamus was, he predicted the future by looking into a mirror and was able to foresee what was in front of us. And if you were the Nostradamus of investors and you could perfectly time getting in and getting out of the market, and you sold at the start and at the end of every recession and rode every rebound perfectly, since 1940, you would have had a return of about 7.3%, annualized. Now, what if you were not quite Nostradamus, but you were darn near good, maybe like Josh, my internal, like he's really good at what he does. And maybe he times it, you get an opportunity to maybe get in maybe 3 months before the recession, maybe 3 months after it kind of, it ends. You kind of saw an annualization, kind of fall down to about 6.7%, still very sizable. Maybe you were a little bit different. Maybe you're 1 year before, 1 year after. So you missed, more of that categorical big swing, as it started the recovery. And it certainly erodes a little bit more. But let me show you something, the most impactful part of this slide. If you just would have stayed invested the whole time and not tried to time it, you would have had the same return as Nostradamus. You would have stayed invested, rode it all the way up, and you would have ended up in the same place. So again, buying and holding, not trying to time the market, but staying, maintaining your time in the market has always been the more powerful conversation, when it comes down to really trying to set the stage for everything that's there. And then lastly, I will bring it back home to this. We all probably understand the concept of dollar cost averaging. Finding ways to get in the market at different times lowers your cost of investment, lowers your cost of getting involved. And you see this a lot with bond ladders. Certainly you see it with other instruments as you start to ladder them at different times in order to have, more success in the longer, conversation. So, trying to go all in at one time, certainly that has its benefits of buying and holding, but at least trying to get a dollar cost average and buying in at different intervals has always proved its test of time by lowering the cost of entrance and maximizing the outcome there. So let me pause there for a second, Maureen. I don't know if we had any questions pop up in the chat, but before I kind of transition here to the next point, I figured I would just open it up to you to see if there was anything else that was being brought up. So I'll kind of take a brief pause.
Tim, thank you. Right now, we don't have questions from the field.
Okay, perfect. All right. So when we think about, the emotional decision to keep cash on the sidelines and transition that cash, you might scratch your head and say, what is out there to help me help my clients drive these confident conversations and get them back involved, right? Because maybe they're not looking to jump into a straight index fund in an open brokerage account. That's just still the opportunity for risk and loss is just, you can't alleviate that fear. Well, the good news is, with our partners here at DMI, they have a lot of options on there. And certainly as trusted partners with Lincoln is just one of the partners that they bring to the table. But let me introduce to you today, on one of our platforms, our FIA, our fixed index annuity, our platform called OptiBlend, which is available in multiple durations. we have an incredibly simplistic strategy that helps you win consistently, and takes all risk off the table. And this is just one of about 8 different strategies we offer. But for simplicity here today, I just want to take the opportunity to highlight one here with you guys here today. And the one I want to highlight is our S&P 500 Performance Trigger account. And what makes this conversation and this strategy so powerful is when the S&P is flat at 0 or positive in any way over your 1-year contract duration, your client earns the full triggered stated rate. So if the S&P, in this example here on our screen, we're showing a rate of 8%. We're actually higher than that here today, but this rate we're showing for our example here today is 8%. Imagine the S&P over your 1-year contract finishes up 2% in that year. Your client receives 8. If the S&P finishes up 6% in the contract year, your client still receives 8. If the S&P finishes up 10, your client still receives 8% on the performance trigger. So it's an all or nothing bucket, keeps that belly to belly annual conversation simple. And on the downside, if the S&P finishes negative, your client has 100% principal protection. So when you think about 100% principal protection, what does that mean for your client? You address the emotional decision of the fear of loss. So instead of sitting in cash and earning very little in money markets or maybe even some short-term CDs that are out there, the opportunity to earn, index-like returns without putting the money at risk. And oh, by the way, OptiBlend has no fee to the client. This creates a very strong story addressing both the upside potential, the downside emotional concerns, and allows you to also continue to generate revenue for your practice and your book of business. So a win for the client, a win for your overall book of business as well. So this is a strategy. We had a record year last year. We continue to see record flows into the strategy. And as I continue to have this conversation, one of the things I'm going to show you here is one of the case studies on how people are leveraging this strategy. So some of you might say, well, how people are using this? Well, whether you go all in one of our strategies like the performance trigger because of simplicity, or you choose to leverage as an allocation on the platform, like I said, we have many. This strategy is a case study for you here today, because what if, really over the last 10 years, you decided to invest $100,000 and you go ahead and you just, in the bottom right-hand corner, you can see that it was equally allocated across 4 of the different options that we have inside our actual contract. What does that do? Well, you compare it against the Barclays US Ag, right? So compared to other bonds that we see, most being used from an index standpoint, right? So you're using the S&P 500 on the Lincoln platform compared to the US Barclays Ag Bond Index. It outperformed by over 34% over the last 10 years, all because you take off the opportunity for loss. So by removing loss and the fact that you lock in gains every year and allow that compound, by preventing the loss, you outperform, add that confidence, and put your clients in a significantly better position. And when we think about the current environment we have, which we all know, it seems like we're going back and forth here with the Fed. If the Fed's starting to lower rates, now that doesn't directly affect bond prices, right? But it does indirectly affect bond prices. And, quite frankly, as we've seen yields up where they're at today, does this mean that the party's over with some bonds as we start to see, rate drops? And is there a compelling reason to really act with more urgency today before potentially seeing some indirect opportunities, off the table here in the near future? So an opportunity here, whether you're a diversified approach by spreading across multiple accounts, whether you're looking at it in the opportunity to capture that upside with the S&P 500 versus just one of the most used bond indexes on the planet, the US Barclays Ag. So outperforming by 34% over the last 10 years, all while not having to perform in any type of loss scenario. So when we think about this scenario, I also want to take the opportunity here to talk about one second different strategy on the table. And that is, if we were to compare leveraging, just our performance trigger and then taking it with, one of our other index options, just our participation account, both on the S&P 500. And we compare it to one of the best selling, products over the last 20 months, which is a 5%, my guarantee fixed annuity, or even if we compare it to a 5% paying CD. The fact of the matter is, when you use a blended allocation without the fear of loss and the opportunity for compounding, we outperform a 5% fixed rate time and time again. As you can see, the lines on this chart never touch. As a matter of fact, in order for you to perform at the same rate that we can offer you, and we have shown inside of our OptiBlend platform, utilizing a simple strategy like this, you'd have to have a fixed rate of over 6.7% in order to match it. So if you're not getting 6.7% in other strategies that you're using, again, your cash that you're using is underperforming. And when we couple all these strategies with the fact that we know that Americans are speaking the loudest with their voice by showing their fear of what to do with their money, I'll leave you with this. If you are not talking about strategies like this with your clients, the vast majority of Americans have three people that they look for financial advice. One is typically a friend, and two are usually industry professionals. And if you're not having this conversation, one of their friends are, or another financial professional is having this conversation. And if you want to have these conversations, your team here at DMI, your partners here at Lincoln, we are always available to help you have these confident conversations and help your clients get involved. Because if you have these conversations, they're more likely to continue to keep assets and help you grow your net new assets year over year as you're continuing to help your clients find ways to protect them, protect their retirement, and ultimately protect their families from the inevitable costs that we know as we age continue to go up and up in our, American society. So guys, when you think about it, the opportunity here today to sit here and have a conversation about how to have cash move, why getting it off the sidelines is critical, and the impact it can have positively with your client and ultimately your client experience has never been more paramount. So with that, I want to say thank you. I know that Maureen and Eric and Glenn, they wanted to open it up for some Q&A, and I will certainly take a few of those questions. Certainly, my more attractive, better half here, Josh, will also jump in and take a couple of those questions as well, depending on what we have here. So I know, Maureen, you popped up, so I'm assuming you're leading the Q&A part of this. So, I'll let you take it from here, but it's been an absolute pleasure to be here today, and thank you for the invitation.
Thank you so much, Tim. We do have a couple of questions from the field.
Yeah.
So what are you seeing around Roth conversions?
So I will say that, post 2020, with the Secure Act from 2020, we saw a real big uptick in Roth conversions. By 22, that skyrocketed. I like to joke that it was a vertical curve, right? It went from a gradual to a vertical. And as we really look at this and we look at top performing agencies and offices and teams, why Roth conversions have really ticked up is with that 10-year spend down on qualified funds, that has really accelerated the desire for a tax-free legacy, right? So when you think about Roth conversions, whether the money is going to be used for me, as I get older, or ultimately a tax-free legacy to my beneficiaries, it just makes that conversation a lot more friendly for the family when you're thinking about it, right? And where we see it happening is in younger Americans purchasing and then having the opportunity for Roth to grow tax-free and ultimately for tax-free income, or older Americans that find themselves overweight in qualified assets. Maybe it's older parents or even grandparents, and they find themselves maybe uninsurable, right? Maybe health conditions creeped in. They find themselves overweight in IRA assets or maybe 401k assets, as we know those balances keep going up. And they say to themselves, how do I get these assets to my next generation more tax efficiently now that there's a 10-year spend down rule? And we saw it increase so much, Maureen, that we actually changed our application in 22. We went from allowing full Roth conversions and partial Roth conversions to offering a simple check the box on our application where you can do an IRA app, check a single box that says, I want to make a Roth mirrored contract, and we will create a mirrored contract side by side with that IRA. One is a traditional, one is a Roth, and you can convert unlimited amounts between the two, no surrender, no penalty, no chargebacks. So we see our top offices doing that with almost every traditional IRA contract. And then what you do is, as you're looking to improve as a professional, you partner with CPAs and attorneys in your area, and they give you referrals to clients and say, oh, hey, my client can maximize 50 grand in their tax bracket this year without going to another tax bracket. Let's convert the 52,000 to a Roth this year, not affect their tax bracket, but then we can allow that money grow to tax-free. And we see those, mirrored contract conversions happening pretty regularly here since we added it in 22. And it's just used to some great success. So the acceleration of Roth conversions to really address that tenant out rule in the Secure Act continues to get larger opportunity. And we see it with planners growing every year.
Thank you so much. We have another question that says, could you talk a little bit about strategies you're seeing outside of historical usage?
All right. So you asked good questions here, Maureen. There's nothing like putting me on the spot. When I think non-traditional uses, typically I would think about, probably like trusts, estate type conversations. Historically, it's not a huge part of the business, but what we noticed is last year coming out of 23, Lincoln had a record year for overall, contracts being sold, but also about 19% of the contracts we sold involved trust ownership. This is an all-time record for Lincoln. And as we look at why that is, it's because of, estate planners and financial planners alike are looking at the sunset of the Tax Cut and Jobs Act in 2025 with the sunset of the very large lifetime gift exemption, which right now is 13 and change. For a couple, we know that's approaching $27 million. And the sunset, there's threats of it being, in the $4 million range. It really, let's be honest, Congress is probably never going to pass a rule that affects them too drastically negative, right? So we're probably going to see it pass probably somewhere in that $5 to $6 million range, but the fact of the matter is it's going to be probably less than half that it is today. And, that's going to put a lot more Americans back on the hook here for potential estate taxes. So a lot of the more advanced planners are taking the opportunity to leverage trusts, get money out of the estate today, which still allow owners to maintain control of these assets, leverage them for what they want, add liquidity. But ultimately, if they're not going to use it for themselves, ultimately it can fall to their beneficiaries outside of the estate, leaving it outside of that, overall estate tax, and allowing them to plan more effectively while using these really the highest watermark we've ever seen in estate tax, lifetime gift exemption. So, continuing to see that. Again, 2024 is off to a banner start in the first 6 months. I don't have the exact statistic, but between Josh and I, we talk trust a lot. We have a full trust team, trust attorneys, tax attorneys, and it is something that we talk about very frequently. So the Tax Cut and Job Act is weighing very heavily on a very large planner group, and we continue to see trust being used, and we're very trust friendly.
Yeah, I noticed even though it's not going to be until the end of 2025, people need to start planning with their clients and having the conversations now. Actually,
Sure,
that's why we're having a webinar in August. So if anyone's interested in simplifying the sunset, come join us on August 14th. And the link for that is going to be on dmiuniversity.com. And I can include it in our webinar follow-ups as well, because it is such an important topic. You don't have to know everything, but you need to be able to hold on a conversation with clients and prospects before they go talk to somebody else.
Without a doubt.
Yeah, Maureen, actually, I thought maybe I'd jump in here for a second and just share our upcoming list of webinars. So the one that Maureen just described is on August 14th. But then we've also got a series of sales webinars, how to maximize engagement, how to unlock client commitment, how to master discovery. So I think all of these are actually germane to what we talked about today.
Yeah.
And then in October, we've also got an LTC Insider's Guide. So it's all kind of connected, right? But just wanted to share that with everybody. This is available on DMI University. Go check that out. There's registration pages next to each one of these upcoming webinars. So with that being said, though, I also wanted to see if Josh or Eric, you can pop back up if you like. Don't be afraid. It's okay.
I do know we're having
Yes,
internet issues with different people, so that we need to take that into mind with the weather's going across the United States in the last day or so too.
Yeah, I'll kick it over to Josh. Let Josh take it from here.
Hey, Maureen, can you hear me?
I can, thank you.
Awesome. I mean, one of the other items, first and foremost, Tim talked about having the better looking half. I think that might have been too much pressure at this point. So I had to turn the camera on at some time, right? Two of the things that we really see happening a lot with the discussions, at least I'm having, more and more agents, especially with the Secure Act nowadays, they're like, hey, do you guys house this? Where can I find solutions for some of this qualified money? Tim talked about what happens with some of those Roth accounts and laddering those Roth accounts. But what if I have a qualified account and it's a Benny IRA, right? What are my options here? So obviously we know that it's going into that 10 pay, so we got to get it out in 10 payments, right? One of the places we're finding the most solutions for it, as well as leveraging your relationship with the client to engage them even further, is looking at that tenure as a 10-pay SPIA. Right. But let's take it a step further, because obviously you're getting a 10-pay SPIA, but then as an agent, you're like, well, what am I getting out of this? Right. Like, we're giving these clients the payments over the 10 years, which is great. But we see that leveraged and used as, hey, we'll create a 10-pay SPIA here, but then we can use those payments to fund an IUL policy or a long-term care policy, right? Why not use assets that are not really going to be touched right now, or the client doesn't truly need right now, and leverage that to put them in a better position down the line? Especially if they know, hey, I don't really need it, I'm not using it for anything. No problem. Let's pivot over to an IUL or long-term care. We're set up. We now have another bucket down the line that's less. We leverage our equities more. We can leverage our managed money more, but we're actually setting them up in an even better situation than they started out with. So I think that's big, because a lot of people don't think about it that way. And it's one of the things that we see rising, especially with agents looking at opportunities for those funds. So definitely want to put that out there, right? Now, on top of that, we also accept non-qualified Benny accounts. So, we have solutions for those beneficiary accounts. And on the non-qualifieds, we allow that on our OptiBlend platform that Tim just spoke about, as well as our MIGA platform. So if they want to be protected against loss and just take out those required distributions every year, great. We can do that while, preserving that capital. And what I see most often is they'll start spending down or taking those RMDs, but at the end of that time period, or maybe it's 20 years, right? At that end of the time horizon, there's still funds left over. So not only are they distributing those payments throughout their life expectancy, not only are we giving downside protection, but sometimes at the end, if the accumulation is there, we can even still leave a small legacy behind to the client as well. So again, let's not reinvent the wheel, but let's work with the assets we have, expand on those, and that's only going to engage the conversation with clients, right? Because as we come up with more ideas there, then it opens them up to come back with, well, I have money elsewhere, or I have money here. And one of the things I see being the most instrumental in some of these conversations that agents are having is our marketing. Everything that Tim just showed us today is all available for client use. So why not have something most clients want to hear from the carrier's mouth, right? They want to see something that says guarantee, or this is what we plan to do. And with all this marketing that's client approved, that's where I get the most positive pushback from, is saying, hey, at least I can put this in front of a client and support what I'm saying and lend credibility to myself and the conversation. So that is a huge part of it as well, is using some of our marketing materials as well as us on those calls.
Yeah, I love the fact that you run everything. Everything is client approved. And I think we're actually going to be able to make that cash conundrum as a PDF available to any agents and advisors on DMI University. I'll try to follow up with everybody with contact information. If you don't have talk to your DMI representative, your DMI vice president. But if you don't have one, contact Eric Baldwin. His information is in the chat that I gave everyone at the beginning. But also, I'll include that in my webinar follow-up to everybody, as well as the PDF that you guys have supplied. So that's great. And I do have someone who raised his hand, which, hold on a minute, because I'm not even sure. Oh, I raised my own hand. Hi. Maybe someone lowered their hand. So, okay. Well, if anyone has any last minute questions or want to raise their hand, we're here for that. But if not, I want to thank everyone for joining us. Jean Bond. Hold on, Jean. I'm going to allow you to talk. Go for it. Jean, do you have a question? Okay. Sorry, Jean. But you're welcome to follow up with us, and I will get any of your questions answered as soon as we get that. Oh, something's in the Q&A. I had to miss the beginning. I'm so sorry, Jean. We will send you a copy of the webinar. No worries, but welcome, and I'm glad you could make it. And in lieu of Glenn or Eric Baldwin being able to close this, I guess I am. So thank you very much, Team Lincoln, Tim and Josh, for joining me today, as well as our marketing director, Glenn Setchfield, who isn't here anymore, and Eric Baldwin, our new VP. So everyone, thank you for joining us, and I will be looking forward to you on the next one. Thank you.
Thanks, Maureen.
Thanks, everybody. Thanks for the time.